Good morning, Dr. Shriver. My name is Galen Griffith. I'll be covering the sensitivity analysis and capital budgeting. So, the goal of the function of financial management. The primary objective of financial management is to maximize the shareholders' value. Financial managers make investments, financing, and dividends decisions. Each decision requires balanced risk and return to ensure optimal results for the firm. Capital budgeting is the decision process that companies use to identify projects that add value to the firm. Before a company invests in a new product, service, or marketing, it must first have enough capital to cover its costs. The importance of having a strong budget is that if the company invests too much, the risk may be too high and there is a chance of losing the investor's money. If it's too low, then the technology and equipment will become dated and obsolete, causing a harder time for companies to stay relevant. Capital structure refers to the method by which a company determines how to fund its operations and investments through debt and equity it has raised. A strong capital structure helps reduce risk by balancing the debt to risk ratio, allowing for financial stability which will attract investors in the long run. As companies progress and begin to generate profits, it needs to devise a method for distributing those profits to its investors. Having a dividend policy will create a framework for distributing profits to shareholders. If a company's payout is too low, it can signal distress to investors. However, if it's too high, it can deplete the reserves needed for future growth costs. Moving on to the sensitivity analysis. So sensitivity analysis show how different values of an independent variable affects a dependent variable under a given set of assumptions. Companies use sensitive analysis to identify opportunities, mitigate risk, and communicate decisions to upper management. The purpose of this analysis is to understand the influencing factors, what factors affect the outcome of a specific project, and what input variables impact the output variables. Reduce uncertainty, inform the project members of what to be alert for or what to plan for. Achieve goals. A company can better understand how a project may change and what conditions it must be present for the team to meet its targets. This kind of brings us into different kinds of factors. So the quantitative factors are measurable inputs that drive a financial calculation. Assets, price, and return data are the basics for any financial model. These are the foundations for calculating risk and return. Risk is measured using data to predict future fluctuations, volatility, whereas volatility refers to the price fluctuation such as stocks, bonds, currency, and derivatives. Market and economic data deal with how an asset performs in relation to economic indicators such as inflation rates, the health of the economy, and unemployment figures. Company-specific risks are associated with random events that do not affect the market as a whole but still have an impact on the company's financial outcome. Qualitative factors are non-quantifiable factors that influence the success of a project or company. Market competitions is affected by a company's competitors. They can have better prices, have better marketing plans, and different technologies can lead to new products that your company just hasn't developed yet. These factors can then pull your customers, which in the long run impacts your profits. Having skilled managers or workforce is essential for a successful business. This is typically found in more established companies, whereas a newer company is still defining its culture and may struggle in this area. Changes in legal and regulatory environments can introduce significant risk. Newer regulations often alter companies' profits due to the numerous changes the company must make to comply with the new rules. Technology is constantly updating. If a company wants to stay relevant, it must keep up with the new technology and its potential impact on the company's culture. Training will always be a necessity, which can cause discomfort in the workforce due to cultural shift. Capital budgeting involves evaluating long-term investment projects. Tools such as net profit value, NPV, internal rate of return, IRR, and payback period helps managers compare projects since future cash flows are uncertain. Since future cash flows are uncertain, risk analysis is crucial. NPV is the present value of the project's expected cash flow discounted at the appropriate rate. This measures the extent to which the project contributes to the shareholders' wealth. IRR is the discount rate that forces the present value of the expected future cash flow to equal the initial cash flow. In other words, IRR tells you the break-even interest rate where the project pays itself off. The payback period is known as the number of years required to recover the funds invested in a project from its operating cash flows. Even with all the analyzing tools, the uncertainty in future cash flow is always present. All analysis can do is estimate the cash flow and not give an exact point. To help out with the uncertainty, you need to incorporate the risk into the analysis. Market risk is what determines a company's required return on equity when using capital asset pricing model. Corporate risk deals with the risk the project contributes to the company's cash flow, and the standalone risk reflects uncertainty of a project's cash flow. Moving on to uh, integrating risk. Integrating risk into the capital budgeting can be done using both internal methods and external methods. For internal, adjusting the discount rate refers to the value of the money the project is worth in the future. If you use a lower discount rate, you assume that money you invest will be worth the same in the future as it is today. A higher discount rate is used if you believe the money will be worth less by the time you withdraw the equity. Certainty equivalent deals with adjusting the cash flow rather than the discount rate. This method utilizes a smaller cash flow that is guaranteed over a specific period to facilitate their analysis. External method. Economic conditions encompass factors such as inflation, interest rates, and unemployment. These factors can all affect the amount of money your consumers are willing to spend on the product. Political administration deals with various laws and regulations that govern trade, taxation, and government policies. Any shift in these can create significant risk for a company and its financial stability. Market competitiveness covers companies that share the same market space, new and established competitors taken away from the buyers and suppliers. If the market competitiveness is too high, it can put pressure on the profit margin itself. So in conclusion, we went over sensitive analysis and capital budgeting, goals, what a sensitive analysis covers, quantitative factors, qualitative factors, capital budgeting, both internal and external methods of risk. These are my references. If there are any questions, please call.